Hi everyone, and welcome to your final team presentation for BUSA 531. This week, myself, Grant, Janice, Heidi, and Gordon, known to some as Team B7, will be sharing our findings with you on the topic of the Euro crisis. Who is to blame? So what is the EU debt crisis? The term Euro debt crisis is a shorthand term for Europe's struggle to repay or refinance government debt, or to bail out indebted banks without the aid of third parties like the European Financial Stability Facility, the European Central Bank, or the International Monetary Fund. It is important to distinguish between the European Union, which consists of 28 nations with similar political and economic interests, and the European Monetary Union that was created by 19 of those nations, and are unique in that they share a common currency, the euro. Generally, there are 5 countries of the EMU that are central to this discussion. They are Portugal, Ireland, Italy, Greece, and Spain. These countries have to varying degrees failed to generate enough economic growth to meet the obligations of their bondholders. The impact of this crisis is significant and has far-reaching effects. The governor of the Bank of England referred to it as the most serious financial crisis at least since the 1930s, if not ever. According to the IMF, the GDP of the EU is over $18 trillion, which makes it the largest unified economy in the world. Therefore, a failing of the EMU will not only affect the Bank of England, but it will have an effect on the entire world economy. With such a large and complex issue, it is easy to point fingers. But who is to blame? The purpose of this presentation is to answer the following questions and broaden our perspective on this query. The 2 questions we will explore are, is it reasonable to conclude that Greece is to blame for the current euro crisis? And secondly, how can Germany be thought of as the cause of the current euro crisis?
Before we jump into those questions, let's review a few key terms and concepts that are central to our discussion. The Eurozone refers to the 19 European Union countries that have introduced the euro since 1999. The European Central Bank, or the ECB, is the central bank for Europe's single currency, the euro. The ECB's main task is to maintain the euro's purchasing power and thus price stability in the euro area. The current account is defined as the sum of the balance of trade, that is goods and services exports minus imports, plus net income from abroad and net current transfers. A positive current account balance indicates that a nation is a net lender to the rest of the world, while a negative current account balance indicates that it is a net borrower. Beggar thy neighbor is a phrase used to describe an economic policy through which one country attempts to remedy its economic problems by means that tend to worsen the economic problems of other countries. It's also important to understand that a debt crisis can be one of either national debt or private household debt. National debt is usually measured in relation to a nation's economic output, or GDP. Governments take on national debt through the purchase of treasury bonds of other nations, secured by their future tax revenues. The intent is to develop the economy by injecting liquidity into the country via investment in social programs or national infrastructure, eventually ending up in the hands of the general public through the flow of commerce. When GDP growth and associated tax revenues are not capable of paying for the national debt, then a crisis emerges, as we see in the case of Greece. Household debt is typically measured by the level of household debt in relation to the average household income. When this level grows at a rapid rate, for example, in a period of sustained low interest rates, signs of a housing bubble emerge due to the significant amount of mortgage debt in a nation. When the household debt of a nation grows high in relation to that of other nations, governments may step in and back the mortgage market through investment in financial institutions in order to provide protection from default.
Debt and financial mismanagement are why Greece is blamed for the euro crisis. Greece is the 15th largest economy in the EU. The euro crisis is believed to be influenced by the Greek government debt crisis, caused by a combination of structural weaknesses in the economy, overly high deficits, and debt to GDP levels on public accounts. Systemic corruption is a very big part of why Greece is considered at fault. Prolonged deficit spending, economic mismanagement, government misreporting, and tax evasion. Additionally, over-leveraged financial institutions, under-regulation, and irresponsible investors were a part of the problem, along with extensive arbitrage. These conditions allowed Greece to spend well beyond their means, while artificially meeting the deficit target set out by the European Union and Monetary Union guidelines. This has led to unmanageable national debt and the risk that Greece may not be able to make payments. In 2009, it was revealed that Greece had manipulated its balance sheets to hide the scale of its debt. It was more than twice the official numbers. Government deficit was 15.4% of GDP, and public debt was 126.8% of GDP, making it the biggest deficit among EU nations. It triggered spectacular loss in market confidence around the globe. Financial rating agencies downgraded their credit rating for the country, and the Greek government, already struggling to pay back the $300 billion debt, was faced with a sudden rise in the market rate for servicing its massive debts. In turn, the euro sustained pressure on the world's money markets. The impact on the labor market has been substantial, with a current unemployment rate of over 25%. The impact on foreign exchange has intermittently caused the euro to lose, especially with the rumors of Greece defaulting or exiting the EU. Greece gets all this attention over other nations because of their extremely high debt to GDP, which threatens the entire EU. Additionally, they are using money they are borrowing to service debt and not build infrastructure that would create jobs and stabilize the economy.
On the other hand, Greece was not the only nation facing a debt crisis, so it can't be entirely to blame. The other PIGS nations, Portugal, Italy, Ireland, and Spain, were also falling further into debt and economic turmoil, exacerbating the euro crisis. Portugal did not experience a boom and bust like other nations, but their high sovereign debt was the result of growth that had been stagnant for a decade due to a gradual loss of competitiveness, high wages, and a drop on import tariffs for inexpensive Asian goods. Low growth in the economy meant that the government struggled to raise enough money through taxation to fund its spending. That spending was high due to a succession of expensive projects, especially improvements to transport links that were intended to strengthen competitiveness. Italy, the third largest economy of the Eurozone, experienced astonishing growth in its public debt, also complicated by drastic reductions in GDP, over 7% since 2008. Some of the highest corporate taxation levels in the world, combined with a fatal mix of awful financial management, inadequate infrastructure, ubiquitous corruption, and an inefficient bureaucracy, pushed entrepreneurs and investors out of the country, along with much hope for GDP growth. Ireland was an economic success story leading up to the mid-2000s, but its economic growth was dependent on a property bubble. It became the first Eurozone country to fall into recession in 2008. The government pumped €7 billion into its two largest banks in a bailout, effectively turning private debt into public debt. This move did not come without widespread anger at the level of cuts to public spending which followed. Spain also experienced the burst of a housing bubble, along with an artificial and unsustainably high GDP growth rate. The resulting increase in tax revenues served to conceal the Spanish government's expenditures. The government then attempted to support continued development by relaxing supervision of the financial sector, which allowed banks to undertake a process of masking losses by understating past profits and shifting them into future periods. The fallout served to undermine investor confidence and deepen the crisis, leading Spain to eventually seek a $125 billion bailout for its financial sector.
We've described how political and economic decisions made in several nations played a part in the euro crisis. However, now we'll speak a bit about how the very structure of the euro itself virtually guaranteed problems like this would emerge. The euro was launched in 1999 and by 2002 had replaced currencies such as the Deutschmark, the French franc, and the Italian lira, and is currently the official currency for 19 countries. A single currency being adopted by a diverse collection of nations was unprecedented. Equally untested was a shift of responsibility for monetary policy to the European Central Bank and away from national capitals. This has proven to be problematic because, while the EU members adopted a common currency, they failed to adopt a true fiscal union. The wealthier EU nations were fearful of becoming perpetually financially responsible for less disciplined economies, leading to the adoption of criteria whereby member states are to strive for low inflation, sound public finances, stable exchange rates, and low interest rates. However, it wasn't long before two of the largest euro economies, France and Germany, were in contravention and the terms of the agreement were effectively suspended for all. Having abrogated responsibility for fiscal policy to the ECB, member nations lost control over tools such as setting interest or exchange rates. An example where this can be problematic is in times of low or negative economic growth, whereby central bankers will contemplate lowering interest rates to stimulate growth. The ECB, having to be mindful of all members' interests, is less able to be responsive to extreme circumstances. This can lead to interest rates being too high for nations with higher unemployment and too low for those with rapidly rising wages. When determining which economies win in such a dichotomy, the ECB must pay greater heed to the relative size of, for example, Germany's economy. As such, the ECB's predisposition toward anti-inflationary policies resulted in unhealthily low interest rates in countries like Greece, Ireland, Italy, and Spain, encouraging increased state and personal borrowing. Typically, market signals such as high interest rates incent nations and consumers to limit borrowing. Unfortunately, the protection of the ECB muted those market signals in Greece, laying the foundation for taking on even more debt. As the world began to recognize Greece's precarious financial circumstance, a vicious cycle began whereby fear begat higher interest rates, which only incited more fear. Being part of the Eurozone also complicates Greece's efforts to correct its path. For example, had Greece retained its own currency, today's reality would see the drachma fall in value, making Greek exports more attractive to foreign buyers. And more expensive imports would curtail domestic spending power, releasing even more of Greece's domestic production for export. But alas, Greece does not have this lever at its disposal.
Why could Germany be seen as the cause of the financial crisis in Europe? Germany is the largest economy in the EMU, with a GDP of $3.73 trillion in 2013, representing 20.3% of the entire EU. Germany also boasts by far the largest current account surplus of €215.3 billion in 2014, and this surplus is only expected to grow. Due to Germany's relative economic size in the EMU, it has taken a natural leadership role guiding the 19 nations through this unprecedented monetary union. The impact of this leadership has led some to point to Germany as the cause of the euro crisis. 1948's failed German mark left Germany with a history of experience related to rapid expansionary policy, hyperinflation, and the overprinting of currency. German policymakers have adopted strong tendencies toward austerity and prudent government spending. The Germany we know today is quite debt-averse, and despite the low interest rate environment, the German government insists on taking minimal debt as opposed to investing in infrastructure to grow. The dichotomy between German fiscal policies and that of other nations is exactly what critics highlight when looking at who is the source of the European debt crisis. You see, on a normal basis, when a nation requires liquidity for investment or programs, it will simply borrow from the central bank, and if a debt ceiling rises, the government will raise the debt ceiling. These nations only have themselves to answer to. In the case of the EMU, these governments still face the reality of investment requirements. However, with a shared central bank, all nations are required to answer to one body for liquidity requests, a body whose policy is reflective of the strongest economic member, in this case Germany. Through the EMU, Germany has forced other nations to adopt austerity and reject an investment growth strategy in exchange for liquidity. This realist perspective highlights that despite the agreement to work together through a monetary union, support in times of need may not always be available. While some felt that providing support to Greece and other nations was a responsibility of Germany, they have been repeatedly hesitant to do so.
Critics also suggest that Germany has an advantage over other nations and is intentionally using a bigger-than-ever policy to limit progress of other nations. Examples include Germany's lower wages, their use of irresponsible lending practices, and their current account surplus. As a net exporter, Germany benefits from 40% of its production going to EU nations. It could be argued that it is in Germany's best interest to allow existing conditions that encourage continued consumption by these other nations. Friedman points out that if true austerity was enforced within the EU, it would have been disastrous for the German economy, since declines in consumption would have come at the expense of German exports. According to the Trading Economics, for the month of March alone, Greece has a current account deficit of 929 million euros, whereas Germany has a surplus of 27 billion euros. This imbalance of trade and Germany's advantage is highlighted in the graph shown here.
While we have noted that Germany's power within the EU, its bigger-than-neighbor policy, and current account surplus may lead some to believe that Germany benefits on the backs of others, we do not believe this to be the root cause of the euro crisis. Defendants of Germany would point out that their national policy, creating an environment of low non-wage labor costs, making labor markets more flexible and stressing innovation, is simply responsible conservative policy that allows their current account surplus to continually expand. Hans Werner Sinn, a German economist, also points out that the benefits to Germany of their export values may be overstated. For example, in the case of German automobile exports, the aggregate value of the exports include many components which have been imported. In the end, while a case may be made against Germany, there are numerous factors at play which lead us to our conclusion and key learnings.
So, what have we learned? Europe's debt crisis is too complex to place the blame squarely in any one place. The debt levels of Greece and the other PIGS nations has placed the entire EU economy in a precarious position. Germany's austerity approach has served it well, but is not universally suitable for Europe's struggling economies. A common currency without a common fiscal policy makes it difficult to contend with local economic circumstances, and a common currency limits the tools a nation has in its arsenal to address macroeconomic realities. In conclusion, our questions for you are: what impact will a continuing European sovereign debt crisis have on your business or industry? What must change for there to be a more unified and economically stable EU? And given the interdependence of world economies, how can governments act to prevent a future financial crisis?